morning, team. Hope you're doing super well. Andy Fenton filling in for Jason Witten, who is out on sabbatical at the moment, is in transit as we speak, getting ready to go off and do some amazing work with some amazing people in amazing places. So for today, you guys have got me. So give us a shout out. Let us know where you're coming in from. It's been a while since I've been on the Wealth Coffee Chat. But today we're going to talk about some interesting stuff that's been happening globally and potentially run through some things that we can learn about it and how you can ultimately position yourselves in order to avoid the chaos, listen to logic, and make better decisions. Hey, Beck, good to see you. So whack it into the chat. Let us know where you're coming in from and what you're up to this morning. I don't have my coffee, but I'll get one of the team to perhaps bring that past me in a minute. Jeff, good to see you, mate, as always, from the Philippines. And Dave, mate, good to see you this morning. Good morning. And Stu, mate, awesome to see you guys on board. As you jump in, whack your name into the chat. Let us know that you're out there so that no, I'm not having a coffee by myself. And we'll kick into it. So also light us up the chat if you've got any concerns about what's happening in the banking sector at the moment over in the US. There's definitely been some news. The title of this is why Silicon Valley Bank flunked Banking 101. Oh, it's amazing. Is that my coffee? Amazing. Look at that. I actually had my special coffee mug too. Thank you. Which is Back to the Future, because in many ways, some of this looks and sounds like it's a little bit Back to the Future. We've got a number of guys joining on, so welcome all. Bryce, good to see you. We've got a lot of the Friday Wealth, Wine and Wisdom regulars on here as well. Graham, good to see you. James, awesome to see you here as well. So, gang, look, there's a whole lot of stuff that's going on in regards to Silicon Valley. I can't say it. Silicon Valley Bank. I always go to put the B instead of the V. It's unsettling for some people, and we want to provide some understanding as to exactly what's going on out there at the moment and sort of demystify a little bit of the BS, because I've read news articles in a few different directions. And whack it into the chat. Does anybody know, what's actually going on with the banks over in the US at the moment? Silicon Valley Bank, Credit Suisse has been in the news, but let's focus on Silicon Valley because these are the ones that are probably hitting the news more so than anybody else. Whack it into the chat if you can tell me why you think, or why the newspapers are saying that those banks effectively blew up. If you don't know, happy days. You're probably just enjoying your coffee and not stressed out about anything. And you shouldn't be, I don't think. Magnificent. So whack it into the chat if you know why. But didn't hedge their bonds. Okay, pretty much smack on the money. What you're going to be reading out there, that's reading the right stuff there. And we've got... I know everyone started withdrawing all their money. Don't know who though. This is interesting. So there's a couple of different levels of this. Now, if you're reading the papers, a number of the papers that are probably a little bit misinformed are out there touting that it's a liquidity crisis. What does that mean? It means that the bank doesn't have enough money to give to its clients because the clients are all taking money out. And look, that's not really the case in the case of Silicon Valley Bank. Silicon Valley Bank, in my opinion, kind of flanked Banking 101. And what we need to understand is when it comes to banking, right, banks, and let's just preface this by saying Australia has some of the best regulated banks in the world. One of the things that we seem to have gotten pretty right out here is the 4 Pillars policy. That was a Costello initiative. Really made Australian banking system one of the best banking pillars in the world and the safest system in the world. So we're very, very different to the US. from that perspective. But ultimately, what banks do is they should, and this is a bit of a tip as to why what happened. They should hold a diversified portfolio of loan risk, right? And ultimately, they should avoid loading up on any specific risk, like interest rate risk, as an example. So that basically saying the assets of the bank, they should avoid loading up in single sectors and having too much exposure to a single investment. Right now, this is the stuff that underpins the bank. And what I effectively mean by that is, I'll grab out my pen and I'll illustrate it in a tick. But ultimately, they should have a diversified portfolio of loan risk. They should also have diversified funding sources, right? So they shouldn't be effectively giving all of their loans out to the same people. Right? These are two fundamental keys of banking 101. One would almost say common sense banking. And Silicon Valley, well, they violated both of those very, very basic rules. They had highly concentrated risk, which I'm going to take you through in a moment. And they also raised all of their money from very, very similar type of people, being crypto, Silicon Valley, tech industry, which is going through a lot of challenges right now. So ultimately, yes, Jeff, 100% right. It's okay. Biden bailed them out. No extra cost to taxpayers. The one thing I did like about it this time is at least he said, instead of giving them massive bonuses, we're going to fire them for the mismanagement. And it really is, it's a mismanagement. This is pretty critical to understanding when it comes to people talking about liquidity risk and a run on the banks, this is this fear mongering that's going on right now. And I think that we need to understand what the actual ramifications and what the reason for it is. So effectively, Silicon Valley Bank violated two of the core principles of Banking 101, right? Diversify your foundational portfolio, which is ultimately the stability, the investments of the bank. Diversify that. And then don't have all the same customers, because if the tech sector and the crypto sector crash and all of your clients are in that sector, then you're going to have more people wanting to take their money out. But as I said, not a liquidity risk. And I'm going to transfer this into how you can think about this from your investing perspective in property and in shares and in your savings, and how you can navigate it, and ultimately how you can be you can pass Banking 101 and make sure that you're safe throughout the journey. So let's have a look at one of the big mismatches. All righty. We'll go to this view. Right. So effectively, if we have a look at what we would call, the foundational component of the bank's assets, right? And that's the stability of the bank. Bank assets, right? Now, if we look at that, over 60% of that, right? Over 60% was invested in US government securities. Now, US government securities, then they're highly liquid. So this isn't a liquidity problem. If they wanted to sell all of those government treasuries, that's a highly liquid market. They could do that tomorrow. The problem was they mismanaged their investments, because what they did, and this is what we call duration risk. And as property investors, what I want you to think about is fixed term rates in property. Sort of apply the same logic to that, or variable rates, or interest rate rising environment. As a matter of fact, tell me this. What are you guys doing if you own property right now? What are you doing as far as interest rates and planning for the future? What are you doing? Are you planning that interest rates are going to remain stable and you're not going to save any more money? Are you planning on interest rates going up, so perhaps making provision for that in the future? Whack it in the chat. Tell me what you're doing. Shelley, Alison, good to see you guys coming in as well. Oh, so Alison's got one there, raising rent. Yep. So ultimately putting more money back into your pocket. Shelley says, Planning for interest rate increases, 100%. That's great foresight. Tim says building up a buffer, which I think is a fantastic idea. Julie says going up, so provisioning. Yep. There's business talk there. Provisioning, meaning creating more sums, creating more cash to be able to fund potential larger liabilities. Tim saying raising rents, pouring excess, whoops, I've double clicked on the same one. We've gone here. And Chris is saying pouring excess into offset accounts. Right, great. You all passed Banking 101. If any one of you were running Silicon Valley Bank, it would probably still be alive, right? And that's as simple as it gets. So effectively what happened, and this gets a little bit technical, but then I'll break it down to simple terms, right? So the assets that underpin the bank, right? So when the bank lends out money, it has all of these assets, and let's just say that this is $10 billion. $10 billion worth of assets. It's allowed to lend money out of those 10 billion. Whoops, I'll go the other way. It's allowed to lend money out of that 10 billion, right? But it can lend multiple times. So for every dollar, it can lend it out multiple times. So you might typically lend to, tech companies or executives. I'm simplifying this. You might invest to individuals, so on and so forth. So you want a diversified portfolio of clients. Silicon Valley had a very high concentration risk of tech and crypto. But the point that I'm making here is for every $1, you might have $6 to $20 lent, right? Lent out in the market. Right now, what happens is, that provides you with money back by way of interest rates, provides you with money back, and that's how banks make money, right? But here's what happened. Those assets that they hold, 60% of those assets, US government treasuries, highly liquid, highly secure, basically guaranteed by the government. So it was less about liquidity because they could have sold all of them yesterday, but it was about mismanaging their assets because this is what they did. That 60%, right? That 60% of assets, I'll create a couple of them because we're going to use a couple. 60% of those assets were invested in US treasuries. US treasuries, and the yield on them, the time frame was 5 to 7 years. So that's how long they had until duration, at which point in time you're guaranteed by the government to get your money back. Plus, let's just say it's a $100,000 bond, right? And it was at a 1% yield because that's what they were. And so 1%, or actually it was much less, right? It was probably 1% over the whole entire maturity. It was like 0.25%. So the return at the end was actually only $1,000, right? Because it wasn't actually 1%. It was like 0.2%, right? Fast forward, a number of interest rate rent rises. Now you can get the same US treasuries. Same terms, let's say 5 to 7 years, but instead of paying 0.2%, you can now get them at 3% today. So what that means, 3%, let's just say that they're 5 years as we did here. So 3% for 5 years, 3, 6, 9, 12, 15, that's $15,000. So let me ask you this. If you wanted to sell this first one into the market, would you guys pay $100,000 for that and get a yield of 0.2%? Or would you go for this one and put $100,000 into that and get 3%? Which one would you go for? I know which one you're going to pick because you guys are all over it. You're going to pick the second one because you're going to get more money. Right. So what that means, if you want to sell this other one, number 2, Julie, 100% correct. You're going to go for higher yield. So if you're going to buy this first one, what are you going to do? Tough call. Tim, I love it. Tim says number 3. Probably right, Tim. Yeah, 100% number 3. Yeah, you're going to buy the second one if you had to, right? And ultimately, if you do buy the first one, that is highly liquid in the market. No problem. We'll buy that first one, but we're going to buy it at a discount. And that discount is going to be around about 15%, right? So you're not going to pay $100,000 for that bond because interest rates have gone up. You're going to pay less for the bond. So this is where it gets tricky. So then, and I'm not using the exact numbers of the bank, but they're, reasonable sort of ballpark. So what happened to that 60% of assets that they held, which is highly, highly liquid, they dropped in value by 15 to 20% if you wanted to sell them in the open market, right? So not liquidity, because they could have sold it instantaneously or virtually instantaneously. They could have got their money, but they would have dusted 15%, right? If they kept that money for 7 years or 5 years, they would have got their money back, 100% of it plus the 1,000, right? So they hadn't lost money. And this happens, with investments right across the board. You don't lose unless you sell, right? Now, or unless you buy something that goes to zero, unless you buy Silicon Bank, as an example, Silicon Valley Bank. God, why can't I say that? So you don't lose until you sell or get forced to sell. And so as investors as well, the story and the learnings that we can get from Silicon Valley Bank, there you go, got it right, is to manage our risk, to manage our interest rates, to manage our outgoings, right? To diversify our investments, not have too high a concentration risk, and make sure that we avoid getting into a position like Silicon Valley Bank, whereby they had to start to pay money out. And when they had to start to sell these assets, the assets that they had diminished in value quite significantly, which meant that it wasn't a liquidity crisis. No matter how much you see in the news out there, in my opinion, not a liquidity crisis. It was actually a solvency mismatch, right? The bank became insolvent because its assets devalued quite significantly. And that was the reason. That's the reason why Silicon Valley Bank flunked Banking 101. So what do we take from it, team, as we wrap up for the day? Why did they have to sell, Julie? Well, typically what happened is that they were overinvested in a very simple, in a single sector, right? They weren't well diversified across their clients. They were, as a matter of fact, they were basically highly concentrated to Silicon Valley tech companies, to crypto. That industry has not done well, over the last 6 to 12 months. And so they do have money going out. They also have banking metrics of which they have to adhere to, right? So they have to have a certain amount of solvent assets on their balance sheet in order to be able to pay out to creditors. Or to pay out to their clients. If the clients come in and they want money out of the bank because they've got money on deposit, they have to give them that money. And I'll talk about that perhaps tomorrow or next week in one of the Wealth Coffee chats, because people start to worry about their money in the banks, right? Now, ultimately, Biden's backed them. But Julie, if they're forced to sell their assets and they're forced to sell them at a loss because they've mismanaged their risk, then ultimately they become insolvent. It's not a liquidity conversation, because they could sell all of their assets. It's just if they sold all of their assets, it wouldn't be enough to have enough capital to then fulfill on all of its obligations. And that was the biggest issue that they had. So it was a mismanagement, and that's why they're in trouble. Here's the $1 million question just before they go. How could they have better managed their risk? It's an interesting question, right? How could they have better managed their risk, assuming that they still bought the same assets, right? And this is what a lot of the funds that I deal with have been trying to manage. We'll use this color. And it's happening this side here. And it's duration. They fucked themselves, Julie. Yes, 100%. That's exactly what they did. If they manage their duration, and here's the thing, in business, I'm in business, if I mismanage this on a day-to-day basis, my business goes belly up. That's the case, goes insolvent, right? Every business owner that's listening to this, if we mismanage this sort of stuff, then, you know, we're gone. There's no points for second place. We're cactus. But we manage it well. And that's why I say they flunked Banking 101. And I'll talk about the regulators a little bit in a minute. But if they took this 5-year and they had that at 1 to 2 years, right? And this is what we call duration. So instead of buying bonds for 5 and 7 years, which is quite a long period of time, you know, when interest rates are so, yes, Julie, 100%, you're bang on the money. Shorter bond durations, which would mean that this 15% would be far less of a loss, and potentially, that 15% would have been far less of a loss. They might have dusted 1 or 2%, and they would have remained solvent. So they mismanaged this longer term treasuries issue. So when you're looking at papers about this, when you're looking at the news about this, which I'm sure there's going to be lots of in the coming days and weeks, think about it from that perspective. And from an investor perspective, what we need to do is we need to be managing our risk. We need to go, okay, well, interest rates are likely still going up. We've been talking about that. How do we manage our solvency risk? How do we manage our Banking 101? And you've already explained it throughout the chat. You know, we make sure that we've got good buffers. We make sure that we've got good reserves, you know, within our investment portfolio. We have diversified, you know, potentially we have properties in different states. We have shares in different parts of the world and in different sectors, from energy to banking to, you know, medical, so on and so forth. So some of the fundamental reasons that the bank failed has nothing to do with an overall banking crisis. It has to do with the bank's mismanagement of their assets and their position. One thing to watch moving forward, and the Fed has already taken some pretty significant action to try and help out the situation. What they're doing is they're allowing banks to value those treasuries at book value, which means that, you know, if you paid $100,000, you can value it at $100,000 in order to help shore up banks' balance sheets, not what they could sell them for today. But ultimately, you're going to see a lot of movement here. The big question for me comes, well, maybe has the Fed mismanaged Banking Regulation 101? Because they know if they continue to raise interest rates, and they know they're going to, in order to fight inflation, they need to be regulating what impacts that's going to have on banks in the US. That's, I think, the bigger question. And they're already looking to sort of manage these challenges in how they allow banks to report, how they allow banks to hold their assets and report on their assets and their solvency. So there's already a number of things on the way, but there'll be a lot more to talk about this in future days. And really curious as to what you guys have questions about, because I'm going to run a couple of these over the next week. A couple of special guests coming on for the coffee chats while Jason's away. He will be popping by for little cameos here and there, so stay tuned for that. But shoot through your questions or load them up at the beginning of our chat so we know what they are and I can try and answer them. But for now, understand that wasn't necessarily a liquidity crisis. It was a management mismatch and a solvency issue that they did through poor bank management. You guys know how to manage your affairs better. If only you were in charge of Silicon Valley Bank, it probably would be above water right now. But Humpty Dumpty, I love you, Julie. Humpty Dumpty, unless they change the ways they do things, 100%. And look, I think it's important for us to understand what's actually happening. The media are going to beat this up and say that it's the beginning of a crisis. Now, this will have flow-on effects. And Credit Suisse, we'll talk about that another day, completely different issues. Two things happen close to each other, then conspiracy theorists go, oh my God, the world's going to end and the banking system's doomed. Not the case, different reasons. Treat everything on its laurels. You know what you need to do. You need to manage your risk. You diversify your investments. You plan for a rainy day. Plan for the worst, and look and hope for the best. But make sure that you're covered. That's it for me for today. Make sure that you build your buffer. Make sure that you manage your risk and diversify your holdings, and look for the truth. Silicon Valley Bank flunked Banking 101. I think most of you guys would be better at the helm. Great having a little coffee with you guys this morning, and look forward to hanging out a little bit more. Let me know if there's anything that you want to talk about, and I'll catch you over the next few mornings. See you, gang. Have a wonderful day.